Hey, folks, welcome to Soaring Profits once again. As always, your hosts, Patrick and
James.
Yeah, welcome back, folks. And one of the big things we got to talk about today is the stock market. What is happening in the world of finance? What is happening in the world in general? And how's it going to affect you?
And so mostly, how come my portfolio has been cut in thirds?
Well, I tell you right now, we are in a very weird time in the market. We've had some conversations over the last little while about where we see it, how we see it coming and unfolding. But we are in a situation that's somewhat unprecedented. We had CPI come out this morning, which is, again, those of you who have been following with us, the Consumer Price Index, and it tracks everything that people have been spending money on. Tomorrow, we're going to get the PPI again, and this is the Producer Price Index. They weren't good. Inflation is still up. And where we are right now is we've seen a really steep rise, and we're flattening. But the problem is the flattening is still having some rise to it. So what this is likely going to mean is that we're going to see the federal banks across the world really hit us with higher interest rates, okay? So this matters if you're buying a house, buying a car, financing your business, whatever you're doing. Money is going to cost more to borrow, okay? So at the end of the day, what this breaks down to is that unless you are buying something that everybody needs, a commodity, a Coca-Cola, we've used them as an example in the past. Yep. Coca-Cola is going to have pricing power as inflation comes up. And folks, I'm gonna be the first one. If you haven't heard it already, we are in a recession. I'm calling it now. I feel like I'm not necessarily calling it early. I think we're there. I think we've already seen the writing is on the wall. We are in a recession for 2022. Okay. What we're looking at right now is this is going to allow the Federal Reserve in the states and the federal banks around to basically kick the crap out of us with interest rates for the next year, right? So what we're going to do is we're going to see probably a 0.5 or a 0.75 in the next probably 2 months. That doesn't sound like a lot. That's 50 basis points or 75 basis points. That's 0.5%, 0.5%, or 0.75%. Well, what the stock market is freaking out about is that they didn't take into account any of this. They took into account a little raise because that's what the Federal Reserve Bank had been talking about. So now all of a sudden we get a situation where we have the inflation is not tapering off. It's rising still too quickly. And they've got to react. The Federal Reserve with Jerome Powell, he has one job. And his first job is to control inflation. His second job is to create pricing stability. Third job is to create employment stability. So he's trying to maximize employment. Well, employment's good. Numbers have been good as far as that. There's lots of open jobs. What's the problem? Inflation. Unfortunately, these guys, they only have one tool, and it's a hammer. So when all you have is a hammer, everything's a nail, and the stock market is going to get crushed. So where we are right now is we are in a recession that potentially has the wherewithal to be as big and bad as 2008. And I'm going to be the one, I'm going to call it right now that we are in a recession right now. And I'm hoping that this is the crux of it. The major indices are down 20+% now. So that is a market crash. No matter how you want to fix that, that is a market crash. This now can be a record crash or it can be a regular crash.
So you were telling us about recession. And so I was wondering if you could explain exactly what a recession is. I know you've explained a couple of times other times, right, but let's talk about what a recession, like how does that affect me?
Okay, so basically what a recession is that a technical recession is when you have 2 quarters, so 8 months, okay, or sorry, 2 quarters of minus GDP or gross domestic product that is pulled back. Okay. So we've had one already. We had our last GDP came out recessionary. It was lagging in growth from the quarter before. Right. And that all makes sense. When we had, the pandemic, what we did is we leveraged our future, printed a ton of money, and then was like, hey, we're going to make sure that nobody goes bankrupt now. Future, we kicked the can down the road, and now we're into recession. So what a recession means is that the paper recession side of things is that we didn't get GDP growth, gross domestic product growth. How this affects everybody else is that everything gets harder. Like it goes down to that core minimum. Everything gets harder. The business that sells you your groceries um, is seeing a decline in sales, i.e., the same as the country is in gross domestic product. Well, the gross domestic product is based off what your everyday retailers, everyday producers, everyday people are buying and selling. Well, if that starts to slow down, the economy's slowing down.
So
So,
I'm just trying to get it straight. So because my gas is way more expensive, my rent, my housing, everything becomes more expensive, then I'm going to pull back that money away from buying the extras. I'm not going to go out and
right,
buy an Oculus. I'm not going to go out and buy maybe the brand new shoes.
right,
So I'm slowing down the economy
yeah,
because I'm only buying things on specific needs: toilet paper, bread, milk, that kind of thing. Is that what
right.
you're?
Well, and where we've been at is that we've had inflation where the economy's going too hot in one direction and going up. And that's where people are like, hey, I will buy the Oculus and I will buy the new Mac and I will buy the shoes and I'll buy the this and I'll get the really good toilet paper. And okay.
Right.
Well, when people do that, that stimulates the economy. But we have on that's demand. The demand.
Mm-hmm.
Everyone, oh, I want. We're gonna consume, we're gonna take it, and we're gonna buy everything, buy it. Well, but 183 million people are still locked down in China. Well, I'm sorry, folks, we get everything from China. So when you can't have production, because that's production, right? You have supply chain that breaks down. The boats aren't loaded with goods, they're not coming across the ocean anymore. We are demanding, oh, we need it.
Yeah.
We want and want and want, and there's nothing to have, prices go up. Well, what
Right.
the Federal Reserve Bank is now going to do, and we've talked about this before, is they're going to take the liquidity out of the market. They're going to start making people feel less wealthy, right? And you and
Sure.
I have had conversations about poverty before, but
Yeah.
our poverty is all very, relative. And here
Right.
we are again, we're going through what's called QE and QT. So that is quantitative easing and quantitative tightening. So when we have quantitative easing, that's when the Federal Reserves, well, the banks, the Bank of Canada, the Federal Reserve Bank of the United States, that's who we're talking about. When they are quantitative easing, they're saying, okay, we're going to lower rates. We're going to stimulate by buying, putting money into the economy by buying and backstopping equities, which are stocks, right? They're going to buy bonds. They bought mortgage backed securities, which was, remember in 2008, those things were like nuclear. Nobody wanted to go near them, but the government backstopped them during the pandemic. Well, where we are right now is that they're saying, okay, we're not doing that anymore. QE, quantitative easing, forget about it, right? Now we're going to
Yeah.
go to a different policy called quantitative tightening. And that's when they say no more money and they choke it. They choke it right out of the system. They choke it. That's what they
Yeah.
do is they literally choke the money out of the economy.
Right.
And they do that, and we talked a little bit earlier, is that the only tool that they have is this big hammer, and they just whack it with interest rates. They come in and they whack it, and they whack it, and they whack it until people go, stop hitting me. Oh, hang on.
Whack
Hey,
it.
ragged.
Yeah. Yeah.
They
Yeah.
say,
No,
stop
totally.
hitting me. I don't have any more money.
Yeah.
I'm not going to go out and buy the new shoes. I'm not going to go buy the new stuff. And
Yeah.
that's why the stock market's crashing, is because the people that understand this stuff, like what we're talking about, and now you folks, you guys are brilliant, obviously, because you're watching us and
You're
understand this
getting
stuff now.
lessons right here.
Right. The us people who would understand this stuff, you, right? We go and we go, well, fuck, Nike. How can I go to Nike and say, if he's telling me that he's not going to buy shoes, well, what's that going to do to the Nike stock? What's that going to do to Nike earnings? Like, we've hit the peak. Now where are we going to go? We're going to roll over and we're going to start coming down. Well, I'm selling. Well, and then the stock market is all based on cyclical patterns of psychology. If if Nike's if you're not going to buy the shoes and you're overtly telling people you're not buying the shoes, why would I buy Nike stock?
Right.
Right? Like, that's telling me that those things, those discretionary purchases right? You don't need the newest pair of Nikes. Walmart makes shoes, right?
Yeah.
You can cut back an inch. Those discretionary purchases, you don't need it, right? Like
No.
you don't need the new Mercedes. You don't
No.
need the new BMW, right? Those things you're gonna put. You don't need a boat.
Don't need a boat. Ugh.
What a guy.
I didn't
But
buy a boat.
anyways, wow, hey, some of us did. Well, yeah. So what I'm saying is that where we are right now is that we are at a process that is going to get way worse before it gets better, and we need to hit what's called a phase of capitulation. And capitulation is when the market goes, stop hitting me. I'm in so much pain, I quit. And a lot of this goes back to some of you folks know about the GameStop and AMC run that we had, last year and the year before, where you had retail traders that had never had anything to do with the stock market before were just piling in. They made a lot of money and thought stocks only go up. Okay. Well, there was a whole new class of investor that was born in that age, right? Well, I'm sorry, but this is an old boys game and they don't want you in it, right? They're literally demanding that either you learn real quick or we are going to spank you right out of town. And that's what this is right now. We're sopping up the liquidity out of the retail investors and we're going to take all that money off the table and you're not going to be able to afford your Nike running shoes anymore. And that's where the world's happy. The world's happy with different classes of people.
But like you were saying, like you've told me many times, that doesn't mean forever. That means until we get back to balance, until people start figuring out that spending all this money is not a good idea.
Well, where we are right now is that, again, the sentence that I started with is that we leveraged our future in the pandemic. So if you're to chart this and you take and run through that charting, you can see where the pandemic dives and then it flies up. Like we had massive growth. Well, because we printed, 60% more money, right?
Even in Canada, the money that we gave out was unbelievable.
So when you recovered faster and stronger and everything. And all the politicians. We're so glad for the politicians. Well, now they get reelected and they get to stand back and go, oh, we're sorry, guys, but we're going to tax the absolute bejesus out of you folks because the pandemic. We have to do it, right? So what we've got to figure out now is what is the next move? Where do we go from here? And what is the basement? When do we say uncle, right? And they take their hands off of our throats. Well, this is the whole process. And what we've got to wait for is we have to get to a capitulation. And we're seeing that's when retail is going to run away. The pain is getting there. People are going, oh my gosh, I don't want to do this anymore. This hurts. It's painful. But we haven't seen where the market has said, I'm done. And I figure that's another 5 to 10%. So we're going to see over the next little while an escalator down. We're going to have some rally days. There's going to be some days to make some money here, folks. But you're going to see more pain before this gets better. We're just not in a position yet to see that rally, and that's the issue. So I figure over the next month and a half to 2 months, we are going to see more pain in the housing market. I've talked to you guys before about the housing market, and we are going to see a housing crash. The valuations of properties are too high. The Federal Reserve in the United States specifically have said valuations of properties are too high, and they are going to do something about it. Well, what do? They keep raising interest rates. They are going to crash in some monicum the American housing market. Well, what does that mean? Well, it means that they are going to drop prices 15 to 20 to 25% over the American housing market, I would say by the end of the year. This time next year is going to be a fantastic time to be looking at purchasing properties, whether it be multifamily, individual family, all of that. We are going to flush out an investor class of people that aren't going to be able to make this. So, knowing that information, you have to be smart with your decisions now. You have to figure out which way you want to go on this. Go to cash. We've talked about this before. You need to be looking at increasing your cash flow, whether that's taking in renters, house hacking, right? You take an upstairs, you put it down a duplex or a unit in your basement, bring in somebody, rent a room, all of these different things. You need to increase your cash flow that allows you to then go to the bank and say, okay, I've got $20, $30, $50, $100,000 ready to go in cash, but I also have this income coming in every month. Every month you can see that this income's coming in. And when you show them that, they say, you are a qualified investor. You are a qualified person we're willing to give that second mortgage to, or that first mortgage to, right? Like if you're renting a house right now, get a renter. Get somebody that's going to come in here and that's going to pick up the third or fourth bedroom in your house. Why not? You need to be cash flow. If this goes as bad as it could go, this makes 2008 look like nothing. I'm not there yet. I don't see that this has that in it, but it could. I do think that we're going to see some big problems. So this is what we're trying to talk about every day, folks, is that we try to keep very in tune with what the market is doing on a daily basis, and then we can drag this back to you. This isn't a thing to be fearful of. It's a thing to plan, right? You're going to have opportunities to buy, and buying at the bottom, that creates wealth. Rich people, they may stock trade throughout the day and make some money. But if you can buy at the bottom of a recession, or even if it gets down there enough to a depression, this is generational wealth that you will create, that your grandbabies down the road will go, you my man, you my woman, you made it that I could, go to Harvard, that we could put the library in at Harvard. Like, there's opportunities to be made, right? So I think that's kind of a brief discussion of, where we talked about the recession, and we're going to keep on this every day. Like, we're creating content all the time, trying to inform and create value for our people. And we'll see you guys again here real soon.
James from Soaring Profits. Sorry, you disappeared there for a while, but you carried on lovely.
No worries. Well, thanks again, folks. We appreciate it. Like, share, and subscribe. It's been a night. Share and subscribe, and come on back and see us next time. Yep. Make sure to check out our social media stuff. I don't know if we talk to you guys enough about that sort of thing. When you guys go out and you share this stuff and you put it out to friends and family, we're trying to break stuff down in a way that is bite-sized. Some of these longer conversations, you got to take a minute and digest it. But if you're looking at your portfolio and you're going, holy crap, I'm down 25, 35, 45%, don't watch Dancing with the Stars at night. Do this stuff. Yeah. Right? Dancing with the Stars isn't going to make any money, and it's not going to let you sleep better. It's going to pacify you for an hour. Listen to us, hear what we're saying, take it in. Obviously, we're not advisors, and I'm certainly not your advisor. And, James here, he's not your advisor either. But we're talking about very topic-driven things that are evolving in the market. Do your research, right? We're just giving you an opportunity to think of other ways to do this. And we always try to figure out a way to make it positive, make it fun, a little spin on it. And yeah. So anyways.
And we do stuff like this now. Oh, we can't do it because I don't have a hand, but that's okay. Subscribe. I'm James from Soaring Profits. This is my man. No, it's not going to work. This is my man, Pat, and the guru.
Hey, James from Soaring Profits and Pat over here. Aren't those two great looking cartoons?
Now, with that being said, folks, obviously we are not financial advisors, and we're certainly not your financial advisors. We don't know your risk tolerance. We don't know if you got money in the bank. We don't know what your situation is. So when we're having these discussions, we appreciate you tuning in. However, have some discretion. If you make $1 million with us, we're glad to have you. If you lose $1 million, that's on you as well, folks. Let's work together. Let's make some money, and we'll go from there. Thanks, guys.